Unit 3, Time Value of Money, Lecture 1, Introduction to Financial Markets and Mathematics. We're going to look at terminology that is often used with financial markets. A short position is related to the sale of an asset, so if you are short an asset, you have sold the asset. A long position related to the purchase of an asset, so if you long an asset, you just bought an asset. Bid and offer prices or rates relate to the rates at which market makers are willing to buy and sell assets. The bid price is the price at which they would buy the asset. The offer price is the price at which they would sell the asset. The bid is lower than the offer. Bull and bear markets, they relate to the state of a financial market. A bull market is a financial market that is performing well, and a bear market is a financial market that is not performing so well. Hedging relates to investing, an investment strategy that minimizes the risk of significant losses. Speculation relates to the investment strategy where an investor takes high risk in order to generate high returns. And arbitrage is an investment strategy that is intended to generate what they call risk-free profits. So the idea is to buy the same assets in two different markets, or buy and sell the same asset in two different markets in order to make a profit. We're going to talk more about tenor, yield, and liquidity as we go on. We're going to look now in more detail at the different types of capital markets. Starting with the short-term debt or money market, this is a market in which financial securities are issued for the wholesale lending or borrowing of funds with a term of 1 year or less. We're looking then at the long-term debt market. Here again, financial securities are issued for lending and borrowing, and the maturity on these financial securities exceeds a year and can go up as high as 30 years. We're going to talk about primary and secondary markets. Primary markets are the markets in which securities are first issued. If a company wanted to raise equity funding, that means if it wanted to sell shares in its company, it would issue those shares in the primary market. And in this market, the issuer or the company would interact directly with the investor. And any funds raised in the primary market would reflect directly on a company's balance sheet and would affect the book value of the company. The secondary market is the market in which existing shares or securities are traded. So once the shares have been issued by a company, they would trade between investors in the secondary market. And the value that is affected in the secondary market is the company's market value. The spot market is the market in which deals in securities take place for what they refer to as immediate delivery. So if you wanted to buy a share today, you would go to the Johannesburg Stock Exchange, and the delivery of that share would occur either today or 2 days from now. So that's the spot market. The derivative market, this deals in contracts in which the right to payment or delivery is dependent on the value of the underlying asset. And in addition, that delivery takes place at some time in the future. So the derivative market is actually a futures or forward market. We come now to over-the-counter markets and exchange-traded markets, which we've talked about before. An over-the-counter market involves a private transaction between two parties. That transaction is customized, and as a result, it can take on any shape or form, so there are a wide range of structures with any size or maturity date. But along with that, the price of that customization is credit risk. In an exchange-traded market, a public price is quoted, the contract sizes are standardized, as are the expiry date. The credit risk is limited due to the fact that the clearinghouse acts as the counterparty to each transaction, and it is a highly liquid market. We're looking now at national and international markets. And national market is referred to as an internal market, and it has a domestic and a foreign market. So when we're looking at the domestic market, the issuers live in the country and issue securities there, and those securities are subsequently traded in that domestic market. In the foreign market, the securities of issuers who issue securities do not live in the country, but they are sold and traded in that market. So Yankee bonds are American bonds that are traded outside of the United States. Bulldog bonds are British bonds that are traded outside of the United Kingdom. With an external market, it's commonly referred to as an offshore market. At issuance, securities are offered simultaneously to investors in a number of different countries, and they're issued outside the jurisdiction of any single country. So no single country has jurisdiction on an international market. The tenor of an asset actually refers to the remaining life of a financial instrument. The tenor can be expressed in years, months, or days. So if you currently have a 30-year home loan and you've been paying that home loan now for 5 years, then the tenor of your home loan is 25 years because you now only have 25 years remaining. Tenor is sometimes used interchangeably with maturity. The yield on an investment is related to the income return and is usually expressed as a percentage. So for example, if you own a share and that share is currently worth 100 Rand and you have just received a 10 Rand dividend, then the yield on your investment is currently 10 Rand over 100 Rand, which is 10%. Liquidity refers to the ease with which you can convert an asset to cash at or near its market price. What this means is that if we look at the share that you own that is worth 100 Rand, if you can go into the market today and you can sell that share for 100 Rand or as close to 100 Rand as you can get, then that share is considered to be liquid. What this means is that liquidity requires marketability. It requires you to be able to find willing buyers and willing sellers very, very quickly. So it is safer, obviously, to invest in liquid assets than illiquid ones, because if you want to get a hold of your money really quickly, you're not going to have to lose a lot of value to do that.